Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by President and Head of Portfolio Strategy, Nicholas Bohnsack, to talk all things markets. Nick, how are you doing today?
I'm very well, Ross. Good to be with you, my friend.
Yeah, good to talk to you as well. I think, we need to talk about the broader landscape here. It's hard to call what we've seen weakness because the market remains only a couple of percentage points off all-time highs, but there is an undercurrent of uncertainty kind of percolating through the market right now. And I wondered, just to turn it over to you to get your kind of big picture thoughts on the backdrop right now. What's driving markets? What's important to you?
Yeah, well, I think you hit the nail on the head by offering some context. I mean, we're only a week or two away from having achieved new all-time highs in the U.S. equity market, and we remain, I think, generally speaking, in a general uptrend. That said, to your point, we've seen a little bit of separation here in the last couple of weeks, and I think it can easily be explained by a couple of different facets. Number one, is the market's done very, very well over the last couple of years, as we know and as we've talked about. Two, we're chopping through an earnings season which is extending, into its 25th month, if you will, into its third year, a really strong earnings narrative, and so there's going to be greater divergence between winners and losers, and that's we've seen some of that weakness or some of that disappointment, if you will, come from some larger names, and that's obviously going to rock some selected industries. And I think just taking a little bit of a step back and maybe examining it from a more macro lens, a more 30,000 foot lens, is we've seen some softness in some of the various and sundry economic data as well. So as a package, in front of our feet, there might be enough for the market to go through a little bit of a shakeout. I'd say behind all of that, though, as we think through the first quarter and into the second quarter just ahead of us, the Treasury has been dumping, injecting about 300 or 400 billion dollars of liquidity into the system, and a lot of that has to do with where we are on debt ceiling negotiations. It's not a particularly a Trump thing. It wouldn't have been a Biden or a Harris thing. It's just a thing we have to grapple with while we chop through some of the debt ceiling issues. But that's gonna provide a backstop to U.S. equities, and I think the more discerning investor is just figuring out where are their pockets of weakness and where are their pockets of strength.
Yeah, certainly at this point in the cycle, whether you want to call it mid cycle or late cycle, you start to see the dispersion grow between winners and losers. So a great call out there. With that as the backdrop, right? Well, how does that inform your all's asset allocation decisions, right? One of the questions that I'm seeing a little bit more is U.S. versus international, as international has outperformed a bit here to start the year. But then more broadly, are there any other asset classes that stand out to you as big winners or big losers in this kind of environment?
Yeah, I like the way you asked the question. I think it's okay to suggest that the United States may be moving into a late cycle framework. That doesn't necessarily mean that a recession is imminent, and it's certainly a circumstance, if you will, that can persist for an extended period of time. And it does, as you say, draw out winners and losers. And with that, if the United States is moving into a later phase of the business cycle, that could suggest that cyclicality has moved east, namely into Europe. We were seeing important pockets of outperformance, particularly in the industrials and in the defensive names in particular, defense names, I should say, armaments in particular, and then even into the Far East, into China and Japan, where you've seen some strength and some cyclical uptick as well. So if you were looking at an asset allocation tactically, say over the next 3, 4, 5, 6 months, I think it could be well placed and well considered to have a little bit greater exposure to international shares. I'm not sure we're ready to sort of fold up the tent, however, on domestic equities. I just think we want to shake out and see some directional confirmation as we spoke to earlier. In line with what you mentioned a moment ago, though, Ross, I also want to make sure we're keeping some attention on the commodity markets. This spin of deglobalization, it persists. We're certainly seeing another chapter of that play out, hopefully in the ending of war in Ukraine. But it has a lot of subplots, and so the commodity markets are going to be one we would look to as an opportunity for strength, and also an opportunity to take some volatility out of two other asset classes, equity and bonds, that are going through a little bit of a phase. So a preference for international shares in the near term. Not certainly don't want to dispense of our equity exposure over the longer term, and keeping an eye on commodities would be things I would keep in hand as we move into the second quarter.
Well, Nick, always appreciate you setting the stage for what's to come. We appreciate the insights and hope to get to talk to you again soon.
Appreciate the time. Thank you, Ross.